see that the bullish broadening has broadly continued. Within the last 2 weeks, both the top 10 and the bottom 490 stocks in the S&P 500 have hit new all-time highs. And the US dollar, along with Bitcoin, have soared. We're doing a tour through the assets today. Will there be more upside to follow? A discussion of fading or following certain trends. Joining me now to discuss his latest market thesis and the incredible charts and graphs that he's created for you, including his look at the macro themes, is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien. Great to see you.
Good morning, Pamela.
Delighted to have you join us here today and to help us go on a little bit of a tour here. We'll invite everyone else to send their questions in as well. So things are, I don't know if it's settling, but certainly the markets are well aware of the election result in the United States. There have been reactions in different directions. Let's take a tour through the assets themselves. There's a clear winner here. Should we begin with that?
Sure. If we go to slide 1, you can see sort of the landscape of assets and sectors that I track. And obviously there's an orange one at the top that stands out in a pretty big way. We got up to 93,000 over the weekend. So knocking on the door of 100K, which everyone has been sort of looking for, but then, these things slow down and then it sits in a range for a year almost. So yeah, so maybe we can start just unpacking that. So let's go to slide 35.
Okay.
And this is Bitcoin's long-term track, and you can see a very rhythmic sort of cyclical pattern there. You got these what we call moons, and then you got these winters. And so if you analog the last couple of winters with recoveries, it looks like we're following in sort of lockstep with presumably a new rising wave. And as you know, I've done a lot of work on sort of modeling the adoption of Bitcoin based on past analogs. And so the network size is something that I've really been focusing on. So if we go to slide 38, we can see that the network had kind of the growth of the adoption curve had slowed down this year. At least on the surface, and it's very hard to know anymore using the on-chain data what's going on, because we have the ETFs now, right? Where like ETFs are like 5% of the assets now and growing, and ETFs like Fidelity's and BlackRock and others, they only use a few wallets for all the assets. So like wallets and addresses are no longer entirely representative of the growth of the curve. And also you got like a MicroStrategy buying, tens of billions of Bitcoin. I assume that's one wallet or a few wallets. So it's harder to make sense of how steep the slope is. But one thing we know is that if we go to 39, that, the power law remains kind of in force. So in other words, if you do a power regression of the adoption curve so far, the curve is still sitting on it. And if we extrapolate that to slide 41, and you use some assumptions about real rates and money supply growth, you still get to pretty nice levels if you wait long enough. And of course, there's no free lunch, so there's likely to be volatility along the way. But that's sort of how I think about Bitcoin. It's a network asset with some scarcity features, very unique. I call it exponential gold. And obviously the sense is that you have a more friendly administration to Bitcoin and crypto in general. I'm not buying all the hype about, the Treasury is going to make this a reserve asset. I don't even know that the Treasury has reserve assets. I think that's a Federal Reserve thing. And when we look at slide 36, you see that half of the wallets that own Bitcoin have over 10 million in there, right? So you have a lot of whales who've been there from day one, basically.
Wow, that's fascinating.
Yeah.
I guess you've always known that, but that's certainly
Yes. But so when you think about it, like this is like private money, right? It's a private asset. And so if the government were to stockpile 1 million Bitcoins, like that's gonna enrich some people who created this thing at the expense of all the latecomers, that are gonna like, to me it sounds wrong to do that, and I don't think the Fed would ever do that. And the whole notion that we're supposed to have a reserve asset that protects against loose money, and the administration that is in control of the money find that a good idea is kind of an oxymoron, right? Like then they should have sound money so that you don't need it. So I think there's some hype about it. So the 93,000, I don't think it's all, like some of that will likely fade away, but it's certainly positive that we're heading in a more friendly direction for at least developing tokenization and blockchain and stable coins,
Right.
which I think will get some easy regulation now that a new administration comes in.
The stable coins are, as you've always told us, are actually kind of tied back to the US dollar, though. I mean,
Yes.
it's still ultimately bullish for the US currency, essentially.
Yes, and actually, why don't we put slide 2 up? So yeah, and so there's always been this Bitcoin theme that it's the anti-dollar and the dollar is going to hell. It's going to lose its reserve status. So Bitcoin is the only real money. I've never bought that, and if anything, Bitcoin amplifies the dollar through stable coins, because the stable coins are pegged to the dollar, and having a lot of stable coins in circulation only democratizes the availability of dollars throughout the world. So I think it's actually a dollar plus story, not a negative dollar story. But speaking of the dollar,
Oh, good. Yeah, let's go there.
yeah.
There's a lot to say there. I mean, this has been a massive trade as well,
Yes.
obviously. And we were talking about EM 3 weeks ago, and in the bond side looks kind of interesting, but the equity side, I'm curious what it means globally and individually for the US.
Yes. So, but let's just show the dollar again. We've round tripped from the bottom of the range to the top of the range in like a matter of a few weeks. And if you look at the bottom panel there, that shows it's a little technical, but it shows the 3-month forward contract, 12 contracts from now minus the current contract, which is another way of saying this is the amount of Fed easing or tightening that is priced in to the forward curve. And you can see that the dollar very clearly kind of goes up and down with changing perspectives of how much the Fed will raise rates or cut rates. And as we know, the Fed is now likely to cut fewer times than the market thought, certainly at the beginning of the year, but also just a few months ago. And as that happens, the 2-year yield goes up, the long end goes up, and the dollar goes up with it, because it means that the Fed is likely going to stay tighter than other central banks. And part of it, of course, is the election, this potential for a new capital formation cycle, ongoing fiscal expansion. If the tax cuts that are going to sunset next year do not sunset, then obviously that's going to have a material impact on the deficit. Who's going to pay for that? What does that do to the term premium? And we can throw in the term premium on slide 14. And this is all part of the Trump trade, right? It's a stronger dollar, higher rates, less Fed cuts, if at all, and a broadening market from just the tech domination that we've seen over the past few years to financials, energy, industrials, right? And so tariffs will be the hammer that will be used for negotiating better trade deals, while at the same time incentivizing American, or hopefully North American, company, to include you folks, to build supply chains back, more supply chains back at home. And that would favor, small caps and a broadening into industrials and even utilities to provide power for data centers for the AI trade. But it does mean higher term premiums. And here I have my bond model adjusted for a return to a more normal term premium of 150 basis points. And it tells you that, 4.5, 5 is about the right range. And I do think, and we've talked about this many times, that the return of the Fed model from back to the Greenspan days of the 1980s, I think is very likely, where you get these occasional tantrums on the rate side that, they don't end equity bull markets, but they can certainly interrupt them. And I think we saw that, of course, already several times over the last year. And I think that's likely to continue. So there'll be interruptions. They'll slow things down, but they won't. I don't think they will reverse them.
So it's really interesting. You mentioned small caps within that, and I mean, sort of a basic view of small caps is they sort of blast off as you come out of recession. Essentially, you want to kind of get them on the way out, and that's where they belong. That's where that blast off belongs. But there's this entire discussion of reshoring, which again is going to work for a domestic market and small caps. Can you just take us there to how different that is? How
Yes.
should we be looking at that differently?
Yeah, so let's go to slide 21. So this shows the top 10 and bottom 490, which you mentioned in your opening remarks. And of course, we know the story, right? So this has been an unusual bull market, the sort of the Benjamin Button bull market, where, as you say, normally a bull market begins with a big breath thrust, as we call it, because like the cheaper stocks, with weaker balance sheets, they get annihilated in bear markets because typically there's an earnings recession, there might be an economic recession, the Fed is raising rates and then it starts easing rates. And these stocks, they go from $10 to $2, but then they come roaring back to $10. So the first wave of a bull market tends to be very broad. And then as the bull market matures, it gets more narrow. And then towards the end, it's just the blue chips standing, basically. And this is why historically we see falling breath or diverging breath. We've had the opposite this year, right? This bull or this cycle, the bull market started narrow and has broadened since. So here we have good news, where even though the top 10, the Mag 7, if you will, are still leading in terms of relative performance, the entire market is participating now, or at least most of them. About 75% of stocks are in uptrends, and you can see the bottom 490 are making new highs. They're obviously below the top 10, but they are participating. And so that's, better than, for instance, what we saw in the late 90s. And so it's a good story. So the market seems to be getting broader as it gets more mature. And if we go to slide 24, that shows small caps. Small caps returned back to the highs. They're not yet at new all-time highs. And if you look at the relative performance in the bottom, that still is a downtrend. So again, small caps are participating, but they're not leading. And so it remains a question whether a leadership change on a relative basis can happen in a rising market, or if by definition that leadership change happens because Nvidia and other Mag 7 stocks are getting rotated out of, does that drag the market down? And do you only see the relative performance in a down market? And that it remains a question without an answer for now. But it's a challenge. 75% of stocks are participating. And so the challenge for us investors is, how do we participate in that participation without taking too much risk on these very powerful stocks that could continue to run, or they could not? And that remains sort of a conundrum.
A conundrum, and it's a conundrum that you kind of go at within some of your notes this week and graphs by looking at the valuation story, and taking a look at valuations. They've been grown into through the earnings story. The earnings story, which you always said had to kind of shoulder the burden, has done just that. It's been a great earnings story for the last several quarters. But you do remain with high valuation. So how do you slice and dice that to take a look at whether this can all be maintained?
Yes, so let's start with slide 4. And so yes, so a lot of the red wave trade is in the market already, and that happened in 2016 as well, right? The Trump 1 trade, I mean, by December, it was kind of priced in, right? So the market is brutally efficient to instantaneously discount all new information, right? So this is not like a 12-month thing. Now, obviously, as time goes on and let's say deregulations happen and or not happen, or the tax cuts get extended or they don't, that will be new information that will drive the market. But for now, I think 2025 is going to be different than 2017 in that in 2017, the backdrop was very favorable, right? We had low interest rates, low inflation. The Fed was still barely coming off the zero bound. Valuations were much lower as well. And so now in 2024, rates are higher, inflation's higher, valuations are higher. So in this chart, I show the VIX in the bars, and then high yield credit spreads in the orange line, and the equity risk premium in the purple line. And we're actually back to levels where we were in 2021, when, as you remember, the economy reopened after COVID. Fiscal policy was extremely loose, and monetary policy was, in retrospect, probably way too loose for too long. And that created a little asset bubble. And I'm not saying we're in an asset bubble now, but we're back to those kinds of extremes. And that, gives me a little bit of pause that it's not going to be that easy to sort of build on that. And one way to show that is in the next chart on slide 5. And we've talked about this many times, the juxtaposition of earnings growth and changes in valuation, which combined plus dividends create the total return for any market. You can see that usually when one is going up, the other is going down. And the reason for that is that price always discounts future earnings, not always correctly, but it does always discount them. And so usually when the price is moving up, it's before earnings inflect, and therefore the PE side moves in one direction while the earnings side moves another. Occasionally you have what I call a dufecta, a trifecta, but just for two, which is when both earnings and PEs are moving in the same direction. And if you look at that on the downside, of course, these are the very devastating bear markets of the financial crisis, the dot-com bursting. When you have both earnings falling and the price that investors are paying for those earnings falling at the same time, that is an amplifier on the downside. But the same thing can happen on the upside. And typically that happens during sort of Goldilocks era soft landing. So Greenspan in the 1990s, the 2010s, kind of that Shanghai Accord period. And when you have both earnings growing and you have PEs expanding, obviously you get a very robust bull market. And what we see for 2024 is that the PE is up 29%, earnings are up 8%, and you add them up plus dividends, and you get a very, very robust year-over-year return. We saw something similar to that in 2017. So it almost feels like 2024 is already 2017, and that means that 25 is going to be more like 2018 when earnings continue to grow because we had the tax cuts back then, but the valuation side kind of went into the other direction. So it's a long way of saying I think 2025 will be okay. I think it'll be an earnings-driven bull market. And if we go to slide 10, you can see that earnings season has been very good yet again. You see
there's a couple of questions going in on the earnings. If you don't mind me just jumping in, what sort of catalyst is the big tech earnings due out this week? I mean, could it be the catalyst, what you're sort of discussing? Hard to tell whether the seven story continues or not.
It could be. I mean, typically, I don't want to call the tech move a bubble. It's not a bubble. We've shown that the valuation side really isn't a bubble yet. Valuations of the top 50 are only 25% more than the bottom 450. But typically, these big booms end the same way, right? They grow. These stocks grow because there's a lot of demand. This is the AI trade, of course, and these companies, whether it's Nvidia or companies that utilize the AI, like Microsoft, they rise because of that. And then at the end of the day, the demand starts to not lower, but the rate of change starts to crest while a lot of stuff has been built, right? So these things typically end with an oversupply coming into the market just as the demand starts to peak, and then these stocks essentially, collapse. Basically, that was the 2000 story. Again, I'm not predicting a repeat of that. So I don't know that it's going to come through in the earnings side, because right now there's still a lot of pent up demand. There's not enough power for the data center, so like utilities are at play. So it's all the companies that provide sort of the picks and shovels for the AI, right? That are still winning, and I don't really see an imminent end to that. But it's always good to look at these numbers, because as these trades get crowded, it's no longer enough to beat the earnings estimates. You have to beat the estimate, and you have to raise guidance. You have to do all these other things, like the whisper number we used to call them, and so I think we're still sort of in the middle of figuring that out.
Okay, fascinating, and something to watch obviously carefully this week. Couple of questions rolling in here. One, going back to the crypto story, Bitcoin, and this is, do you think it would be best if crypto regulation moves out of the SEC? That would be a political move. The other is talking about tariffs and the global impact. Do you want to, which one would you like to begin with?
Let me start with the Bitcoin. So I think for a Bitcoin, the ETFs basically, the SEC approved those, right? So I think Bitcoin, there's enough known on the regulation front that investors feel like it's been blessed as an asset class. So I'm not too worried about the regulation on Bitcoin itself. It's more like the stable coins need to be regulated. The general infrastructure of tokenization and blockchains and financial disintermediation, like that's where things are kind of stuck. And I think a less regulatory minded administration, which obviously the new one is going to be, might facilitate that. And I think that's where a lot of the excitement in crypto is coming from. It's not just Bitcoin, but it's just a bigger push into sort of tokenization and using blockchains and things like that. But that requires a regulatory regime that allows that to happen, and I think that's kind of the promise. So Bitcoin, I think, has already been sort of blessed, if you will, by the regulators.
Okay, so that's sort of something that's getting through. This goes to the continual discussion of tariffs. Everyone is concerned about this impact on global markets.
Yeah, I mean, and it's how much of what Trump says is correct. How much is it going to happen? How much is not? I mean, this obviously is a huge question. Nobody really knows. The hope is among us market pundits is that this is a negotiating tactic. It's the art of the deal. You heard the words from Xi Jinping out of China over the G20, very sort of conciliatory words that we can get through this, and I think that is presumably the goal. I think the goal is to bring supply chains back to North America or the U.S. And I think that's already been underway, right? The CHIPS Act does that. And I think we'll see more of that. We'll see deregulation to incentivize that to happen. I mean, it will be inflationary, right? Because you're creating redundant supply chains, at least at first, while at the same time you have the specter of, deportations, again, another unknown thing. And that could be inflationary as well. So there are costs to deglobalization. But how much tariffs on who, which ones require congressional approval, which don't. Unfortunately, nobody really has the answer to that, and we're just sort of hoping for the best.
Everyone's trying to prepare for it, though, in any case, or make a plan A, B, and C, and that sort of thing. One of the things, certainly just wanted to ask a bit more about the Fed, because as you've mentioned, the expectations have changed for how many cuts are needed. Is inflation sticky? Is it not? Is the specter of it higher after the election than it's not? You also talk a bit about, and again, you've been talking about this for some time, is 3 the new 2? And this is sort of where things land on the neutral side of things.
Yes.
Talk a little bit about what the Fed needs to do as it looks right now.
So let's go to slide 15. So Powell was on at some conference on Friday, basically saying what
Weren't you there?
I was not.
You're at a different Fed conference.
Yes. Yes, I was at the Boston Fed to be on Bloomberg Radio, which they were hosting their show from there. But that was an innovation conference. It's not where Powell was. But Powell basically was saying what we're all thinking, which is that, if you get a shot in the arm for the economy, and the economy grows because of the new administration, pro-business, deregulation, extended tax cuts, the story, more fiscal spending, that could actually make the economy reaccelerate, and which could reaccelerate inflation. Remember, inflation only got down to 2.7 on the core PCE, 3.2 on core CPI, and the 2-year average, the 5-year average are all like 3 to 4%. So if the economy reaccelerates before inflation was really declared, dead, which it would do by going actually well below the target of 2%, then you have run the risk of what we saw in the 60s, where inflation starts to rise off of a higher base. And if that's the case, and it's not a prediction, but if that's the case, and it really remains sticky, and let's say we go back above 3, at 3 is the new 2, that should slow the Fed down, right? I mean, the Fed has now moved 75 basis points. In this chart, you see various iterations of the Taylor rule, which is an algorithm that says the Fed should do this based on the labor gap and the inflation gap. And you can see all of them have moved in the right direction. And the Fed is now exactly in line with where those models all say it should be. So the Fed has done the right thing. The forward curve is now bottoming at 3.8. A few months ago, it was 2.6. So the market has walked back quite a few of these rate cuts, which is correct. But so I think the Fed should be at a point here where it doesn't have an urgent need to move. It's caught up a little bit. It's at 4 5/8. It could probably go to 4, but it doesn't need to hurry to do it. And it's better to wait a little longer when there clearly is no clear and present danger in the economy. The economy is not about to fall off a cliff, and wait a little bit rather than do more now and then have to take them back later. So I think the Fed is calibrating this very, very well. And the goal is to eventually return to neutral. If we go to slide 16, you can see R star, which is the real rate, and you can see the actual funds rate, kind of like a pendulum going above and below it. And of course, we've been above it, and now we're heading back towards it. And the forward curve suggests that we're going to go back to neutral, which, all else being equal, is about the right thing to do. Because on page 17, we can see that the economy is pretty well balanced now, right? So the jobless claims in the bottom there have been very stable. The excess demand for labor, which is the gray line, has been fully corrected. So the labor market is back in balance. Economy is humming along, and inflation, at least the rate of inflation, has been moving generally in the right direction. So it all argues that the Fed should be neutral or maybe slightly above, just to discount the risk of inflation, reaccelerating at some point.
You wonder if, from a professional perspective, he might just say, "Yep, job accomplished. I'm off."
Yeah, well, he's got another year and 3 months.
So. Yeah, a lot could happen.
Yeah.
Jurrien Timmer, thank you very much for joining us. We look forward to seeing you again next week. All the best.
Great. Thank you very much.